What's going on, everybody? Liam O'Reilly, Vermont economic realtor. Hope you're doing well. Talking today about the Silicon Valley bank collapse. I'm sure everybody's heard about it. What this means for you as a buyer or a seller in the current real estate market, and how this is going to change things. So, just very briefly, I'm going to go over uh, what caused the bank failure because I think that's very important for what's going to happen in the upcoming weeks here. So I'm just going to read this here. Silicon Valley customers who were largely startups and other tech centric companies started becoming needier for cash over the past year. That led them to withdraw money from their accounts. SVB, meanwhile, needed to keep selling its assets, mainly bonds, at a loss to free up capital so that customers could withdraw funds. But the bank got to the point where the losses were so high, customers began to fear that SVB couldn't guarantee access to every customer's funds. That fueled a massive bank run, which caused the FDIC to step in. Now, Silicon Valley Bank was the 16th largest bank in the US, so they weren't just a small local bank, they were a pretty significant player. And so, if you followed what they were saying, basically, yields have risen on everything, on treasuries, on with the Fed funds rate. As I'm sure everybody knows, the Federal Reserve has been hiking rates over the past year. And as yields rise, prices fall. And a lot of these banks have a lot of their assets in bonds. So their assets are being depleted as these prices rise, as the yields rise. So they have less money, they have less assets. Their assets are worth less than they were previously. At the same time, companies that lend or that keep their money at banks, at Silicon Valley Bank, they are making less money. They are strapped for cash. They are taking money out of the bank to pay their employees, to pay their workers. The economy is tighter, inflation is high, so their costs are higher. The jobs market is still hot, but I mean, at least from kind of what I understand, these companies have a good amount of reserves that they've kept for over the past few years that they're keeping in banks and can use that money to pay their employees and keep the jobs market hot. So when they start withdrawing money and using that to fuel their business from the bank is forced to sell their assets at a loss, and eventually you can only take such a big or so many losses before it becomes a real issue, and in this case a bank failure. So there's a lot of talk about bailouts for this bank and for the customers. The FDIC has the $250,000 insurance on any depositor there, but a lot of these businesses have more than $250,000 in their accounts. They probably spend. I bet a lot of these companies that had accounts there spent well over that on a regular basis. So the $250,000 just isn't going to cut it for those people, which can be an issue because that could cause, if the employers can't get their money, then they are going to need to, then they're going to have to lay people off. Then the business is at risk, not because their business is failing as an entity, but because the institution that they kept their money with is failing. And so I think as far as the bailouts go and people guaranteeing their money, that's why Congress and the Federal Reserve are trying to step in to give businesses their money, even if they have more than 250,000, which I don't think is a great idea for many reasons. But that's kind of my overview of what's going on with the market. So now, what is the Federal Reserve going to do, and how does this affect the housing market? So let's go over to NEFCU, trustee New England Federal Credit Union, that is a local bank here in Vermont. The 30-year fixed rate, their best 30-year fixed rate, is at 6.375 today. So down from 6.5 on Friday, and it has been at 6.75 for the past few weeks as the Fed has been hawkish. They've been talking about raising rates, staying high. But now with this bank failure, as something has finally broke in the system because of their rate hikes, that could jeopardize not only banks, but the businesses and the individuals who keep their money at these banks. Because of their rate hikes, there's a lot of talk of the Fed at least pausing and not doing another 50 basis point hike or a 25 basis point hike, just keeping rates where they are for now and seeing what happens now that we're starting to see these effects ripple through the system. So that's part of the reason why mortgage rates have dropped. Also, treasuries have dropped pretty significantly as well. If we look at the U.S. Treasury market right now, so yields have dropped by, the 2-year Treasury dropped by 50 basis points. 1-year Treasury dropped by 50 basis points. Basically what's happening is people are flooding into these treasuries because there's a fear that a recession is going to happen, that this is going to ripple into the rest of the economy, which if the yields on treasuries drop, then the yields on mortgages will drop, because a lot of the buyers who are out there looking for a return, mortgages are a pretty safe asset to purchase. They're not as safe as U.S. treasuries, but they are a relatively safe return. Not that there's no risk, but there is some risk. So if the return on treasuries goes down, if the yield drops on treasuries, investors have to start to look for another place to put their money if they want something that's a little bit riskier, but they want a little bit of a better return. And so if yields on treasuries are dropping, then they don't need as large of a spread between the treasuries and the mortgage-backed securities that they can purchase in order to get the return that they're looking for. So that is also influencing the mortgage market and rates. Now, what do I think is going to happen as far as mortgage rates go? We've talked about it a lot on this channel. A lot of markets across the country are experiencing a supply issue, not a demand issue. I mean, sure, demand far outweighs supply, but at the end of the day, it's not that there's too many buyers. It's really that there's not enough homes for people to buy, which is keeping prices elevated, at least around here in Vermont, and I'm sure in other markets across the country. And in markets where there's more supply, prices have fallen more significantly. So now as mortgage rates start to drop again, I think that is going to make things more affordable for the average buyer. We still aren't seeing mass layoffs. The jobs data is still good. So housing is going to become more affordable for buyers if the Fed decides to pause, if the Treasury yields continue to drop and mortgage rates continue to drop, then purchasers are going to have more purchase power. So I think, in my mind, as long as we don't see massive layoffs, as long as this issue doesn't systemically spread, now could be a great time to purchase a home while there's a little lull in the mortgage market. Now, at the same time, if this issue does start to spread and more banks start experiencing these failures, which they're not going to happen overnight, I don't think we're going to see all of a sudden 6 banks fail next week or anything like that. But it could be, in 6 months from now, another bank fails. Maybe there's another situation similar to this one. So, in that instance, these things take time. They're big institutions. They're big moving machines, and so if they're going to fail, it doesn't necessarily happen overnight. It happens over an extended period of time. But if this does start a trickle effect and these banks do start to fail, then we could see, depending on how the federal government reacts and how the Federal Reserve reacts, we could see not only banks go out of business, but also the businesses that hold their money with these banks. And also that, the money that's lost by these banks, the loss that these banks are taking, where the money that comes to bail them out and the money that gets paid back to these businesses, where does that money come from? That money comes from either us as taxpayers or the Federal Reserve, that is going to essentially have to print more money or reallocate funds to give to these businesses, which is going to add more money into the system. Right? They were raising rates, which was taking money out of the system, which caused Silicon Valley Bank to have to collapse because their losses were so great. And now, if they're going to give money back to these companies and to these individuals that have over 250,000, that money is either got to come from the taxpayer, from the average citizen, from you and me, or it's got to come from the Federal Reserve in some way, whatever special system they create, which I think is ultimately inflationary. So, that's a long way of saying I think a pause is probably more likely. I think mortgage rates starting to, we could have seen the peak for mortgage rates. They might start to come down or at least stabilize at the level that they're at now. Um, and if so, I think that's going to add to a rebound, especially as new listings in the real estate market are still so low. So let me know what you guys think about this. Obviously, this is an event that I don't think a lot of people saw coming. Not that nobody saw coming. I'm sure there's people that were expecting this, and um, it's just not something that people were focusing on. Wasn't in the mainstream media, and now is everywhere. Now that the Silicon Valley Bank has finally collapsed. So let me know what you think. Leave me a comment in the description. I love hearing from you guys. You have great opinions, and I learn a lot from you. And I hope you get something out of this video. If you're looking to buy or sell a home here in Vermont, all my contact information is in the description. Feel free to reach out by phone or email whenever you're ready. I'd be happy to help you as a buyer or a seller. If you're looking in another state, I'd be happy to find you a great agent in that state, so that you have somebody who knows what they're doing. Other than that, Liam O'Reilly, I'll see you in the next video.